All right, something massive just happened, and most people are looking in the wrong direction. In a matter of days, Western silver collapsed from about $121 an ounce to roughly 85. That's a 37% wipeout. Violent, fast, brutal. And right when Western investors are panic selling, new reports show China stepping in and buying billions of dollars worth of gold and silver. Both Western trading desks and Asian exchange data are confirming this divergence right now. Here's why that matters, and stay with me, because I'm going to show you how to spot this kind of setup before the crowd does next time. If you're holding silver right now, if you're watching this market, your job is to understand what's actually happening beneath the surface. Not the headlines, not the panic, the mechanics. Before I explain what caused this crash, let me teach you something most people never really learn about commodity markets. There isn't just one silver price. There's the paper price, which trades on leverage, margin, and emotion. And there's the physical price, which reflects real demand from people who actually want the metal. Think of it like airline tickets. The screen price can crash because traders dump seats they never planned to sit in, while the actual plane is still completely full. That disconnect is everything. When you understand that split, you stop reacting emotionally to crashes, and you start asking better questions. Who's forced to sell? Who's quietly buying? And which price actually reflects reality? Here's what I mean. When silver drops 37% in days, your first instinct is to think demand disappeared. But that's not how commodity markets work. Most of the trading volume in silver, we're talking about 70 to 80%, is paper contracts, futures, options, ETFs that don't hold physical metal. It's all synthetic exposure that moves on margin and leverage. So when prices dip even a little bit, margin calls hit. Traders get forced to sell. And that selling has nothing to do with whether jewelers in India still want silver or whether solar panel manufacturers still need it. It's purely mechanical. It's leverage unwinding. And once you see that, once you really see it, you realize the paper price and the physical price are telling you two completely different stories. If this is making sense, drop a comment and let me know you're following along, because we're about to go deeper. So what does that tell us? It tells us that when you see a massive price collapse in a commodity, your first question shouldn't be what's wrong with demand. Your first question should be who's getting liquidated? Because forced selling doesn't mean fundamentals changed. It means someone's leverage broke. And that's exactly what we're seeing right now. Now here's what's actually happening with silver. The initial trigger wasn't a sudden collapse in global demand. It was paper market deleveraging. Western traders were heavily leveraged going into this move. Prices dipped, margin calls hit, and forced selling kicked in. When that happens, it feeds on itself. It's like a snowball rolling downhill. Funds liquidate positions to raise cash. Prices fall harder. More margin calls fire. And suddenly you've got a waterfall. That's the primary driver of what you're seeing. This isn't about silver demand falling off a cliff. This is about leverage breaking in the paper markets. And here's how you know. When forced liquidation happens, the selling is indiscriminate. It doesn't matter if the asset is fundamentally strong or weak. If it's liquid, it gets sold. We saw this in 2008. We saw it in 2020. And we're seeing it again right now. Traders who are leveraged 10 to 1 or 20 to 1 don't have a choice. When the margin clerk calls, you sell or you're out. Period. So that cascade you're watching, that violent drop from 121 to 85, that's not the market saying silver is worthless. That's the market saying someone's account just blew up. Now, the secondary confirmation is the price split between Western markets and Asian markets. And this is where it gets really interesting. While Western spot silver is sitting near $85 an ounce, Shanghai silver is still trading around 122. That's over a 40% premium. Let me say that again. Shanghai is paying 40% more for silver than New York right now. Physical demand didn't disappear. It never even blinked. Chinese buyers, Indian buyers, they're still showing up. They're still bidding. They're still taking delivery. So if demand is still strong in the physical markets, why is the paper price collapsing? Because paper and physical are two different games. And when you see that kind of divergence, that massive premium in Asia, that's your convergence proof. The paper market is collapsing under leverage stress. The physical market isn't. It's holding firm. But here's the part that should make you pause and really think about what's happening. China isn't buying because prices are weak everywhere. China is buying because prices are weak only where paper dominance exists. They're watching the same divergence you and I are watching. They see Western exchanges selling off hard. They see physical premiums spiking in Shanghai, and they're stepping in with size. According to reports from both Western trading desks and Asian exchange data, Chinese entities are accumulating billions of dollars worth of gold and silver right now. Not millions, billions. So when forced selling hits Western exchanges, China steps in and converts that paper weakness into real metal. They've done this before. It's almost mechanical at this point. The way I see it, they're treating the crash like a clearance sale caused by someone else's leverage problem. And when a buyer with deep pockets and long-time horizons shows up during forced liquidation, that's not random. That's strategic. They're not hoping prices go lower. They're absorbing the supply that panicked sellers are throwing at the market. And they're doing it while Western investors are running for the exits. Zoom out for a second, because this isn't new. This is the exact same playbook we saw in 2008. During the financial crisis, silver was absolutely crushed, as hedge funds and institutional traders sold anything liquid to raise cash. Prices dropped from around $20 to under $9 in a matter of months. It was brutal. And what happened? China accumulated aggressively near the lows. They stepped in when everyone else was selling. And what followed was one of the sharpest multi-year rebounds in metals history. Silver went from under $9 in late 2008 to nearly $50 by 2011. That's a 5x move. Same pattern. Forced selling, China accumulating, then a violent rebound. We saw it again in 2020. Pandemic panic forced liquidation across all asset classes. Silver collapsed from over $18 down to around $12 in March of that year. Physical premiums exploded in Asia. You couldn't buy physical silver anywhere near spot price. Dealers were charging $5, $6, $7 premiums over spot, and China absorbed supply while Western investors fled. What happened next? Silver rallied from $12 to nearly $30 in just over a year. Same setup, same sequence, violent sell-off, paper stress, physical divergence, strong hand accumulation, and then, not immediately but eventually, a sharp recovery that left late sellers chasing. In 1997 and 98, during the Asian financial crisis, we saw something similar with gold. Western funds were dumping gold to cover losses in other markets. Gold dropped below $300 an ounce. Asian central banks, particularly China, stepped in and bought aggressively. Within a few years, gold began a historic bull run that took it from under $300 to over $1,900 by 2011. Every time you see this pattern, forced Western selling met by patient Eastern accumulation, what follows is almost always a sharp move higher once the liquidation exhausts itself. The larger story here isn't today's price. It's who's positioning for what comes after volatility exhausts itself. It's who's thinking in quarters and years while others are thinking in hours and days. And historically, that divergence in time horizon is where the big moves get made. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this stay ugly? Absolutely. Volatility can remain elevated for weeks or even months. Prices can overshoot to the downside. And no, this doesn't mean silver can't dip below 85 or even test 80 or 75. Markets don't owe anyone a clean bounce. Forced selling can continue longer than you think. More margin calls could hit. More funds could blow up. The technical damage is real, and if you're expecting a straight line recovery, you're setting yourself up for disappointment. And manipulation talk. Here's the honest truth. I see the arguments. I see people saying this is coordinated suppression. Maybe it is. Maybe it's not. Here's the thing. It doesn't actually matter whether this is manipulation or pure market mechanics. Your job doesn't change. Focus on observable signals. Focus on flows. Focus on who's forced and who's voluntary. That's how you stay grounded when emotions are loud, because whether you call it manipulation or deleveraging, the outcome is the same. Paper prices collapsed. Physical demand held. China accumulated. And those are facts you can verify. There are probably 3 types of people watching this right now. Let me speak to each of you directly, because your situation matters and the advice changes depending on where you're starting from. The first type is panicked. You watched prices collapse, your stomach dropped. You're seeing red in your portfolio, and you're wondering if you should just get out before it gets worse. That feeling is real, and it's human. If that's you, I need you to hear this. Your job right now isn't to predict bottoms. It's to avoid emotional decisions. Selling at 85 after buying at 110 feels terrible, but selling at 85 and watching it bounce to 100 feels worse. If you're going to exit, do it based on a plan you made before the crash, not based on fear you're feeling during it. And if you didn't have a plan before, don't make one now while you're emotional. Sit tight. Let the dust settle. Then decide with a clear head. The second type is cautious and curious. You didn't sell, but you don't trust this move yet. You're waiting for confirmation. You're wondering if this is a buying opportunity or a falling knife. For you, I'd say watch the premium. If Shanghai stays above 115 and the premium holds over 25%, that tells you physical demand is still in control. That tells you the paper collapse isn't reflecting fundamental reality. If that premium starts to collapse, if Shanghai drops toward Western prices, then yeah, that's a different story. That would suggest real demand is fading. But as long as that divergence holds, as long as physical buyers keep showing up, this looks mechanical, not fundamental. The third type is strategic. You're thinking in probabilities, not predictions. You're asking where forced selling ends and accumulation begins. You're looking at this as a potential setup, not a disaster. For you, I'd say focus on structure. Watch whether 80 to 85 holds as support. Watch whether volatility starts to compress. Watch whether open interest in the futures market starts to stabilize or decline, because that would signal the leverage is finally unwinding. You're not trying to catch the exact bottom. You're trying to identify when the risk-reward shifts in your favor, and that's smart. That's how you survive long enough to capitalize when things turn. For everyone, the principle is the same. Let structure guide you, not headlines. Let data guide you, not emotion. Because the market doesn't care how you feel. It only cares about supply, demand, and who's forced to act versus who's choosing to act. So here's what I want you to answer in the comments. Where are you in this? Are you panicked, cautious, or strategic? And what's your biggest question right now about how to navigate this? I read every comment. I'll respond where I can. And honestly, your questions make these videos better because they tell me what's actually confusing people versus what I think is confusing. Now, here's where I stand. I'm not calling a straight line rebound, and I'm not panicking either. I'm watching three things very closely. First, I'm watching whether 80 to 85 holds in Western markets. If we see sustained trade below 80, that would tell me the selling isn't done, and we could see another leg down. But if 85 holds and we start seeing some consolidation, that would suggest forced sellers are exhausted. Second, I'm watching whether Shanghai silver stays firm above 115. If that physical premium collapses, that's your warning sign that demand is actually fading. But as long as Shanghai stays elevated, the fundamental story hasn't changed. Third, I'm monitoring whether that premium remains elevated for more than just a few days. A one-day spike in premiums can be noise. A sustained premium of 25 to 40% is a signal. It tells you there's a structural imbalance between paper supply and physical demand. Based on my analysis, this crash was mechanical and technical, not fundamental. The fundamental picture for silver, the solar demand, the industrial demand, the monetary demand in Asia, none of that changed. What changed was leverage in the Western paper markets. Traders got caught offsides. Margin calls forced liquidation, and prices cascaded. That's a liquidity event. It's not a demand destruction event. If history even loosely rhymes, and I'm not saying it will, but if forced selling exhausts itself and quiet accumulation continues in Asia, the move that follows could be violent in the opposite direction. Not because I'm predicting it, but because that's what happened in 08. That's what happened in 2020. That's what happens when weak hands get shaken out and strong hands step in. The snapback tends to be sharp. Now, I'm not a financial advisor. This is not financial advice. I'm sharing my analysis and my framework. You need to do your own research. You need to make your own decisions. You need to understand your own risk tolerance. But if you made it this far, if you watched this whole video and you're still with me, you're thinking critically. You're not just reacting. You're analyzing, and that mentality will serve you well. Not just in this trade, but in every market you touch for the rest of your life. If this breakdown helped you see something you weren't seeing before, share it with someone who needs to hear it. Subscribe if you want more real-time analysis when these setups develop. And stay ahead of the noise by thinking in patterns, not headlines. I'll see you in the next one. Stay sharp out there.